Welcome back. We've seen whipsawed markets after the Fed's decision at 2 p.m. to cut interest rates by 0.5 point. The Dow had been up to session highs, all-time highs, in fact. Briefly turned negative, is up 188. S&P's up 0.5%. NASDAQ, the highest, up 0.8 or so. For more on what investors need to know, Mark Avallone is here. He's president at Potomac Wealth Advisors. What are you advising, Mark? Welcome.
Well, welcome. And that was a big surprise for me. And I think investors shouldn't go out and make any knee-jerk responses. But I think there's going to be some opportunity here. I mean, we've talked about the relative valuation differential between small, mid, and the large cap, mega cap. I think a lower rate environment is going to serve small and mid cap well. So that allocation, still not too late to get there. Again, it's literally about 50% on a forward PE of what the large cap, mega cap is. So we find that attractive. We also think investors, whether this is a slowdown, 50 basis point cut, or a preemptive, we want to get out in front 50 basis point cut, we think technology is the way to go. I know I've been a broken record, but technology, tech-enabled, old tech, new tech, the only tech we don't want is non-cash flowing spec tech. That is not what we want. Otherwise, we are all in on technology.
Let's talk a little bit about interest rate sensitive sectors. And I'm thinking mid-sized banks, most especially.
Right.
Large banks. What happens there?
Well, this may be a contra opinion, but I actually was at Bank of America down the street for a number of years. And my take on banks is avoid. I think what's going to happen is the repricing of loans, now that the Fed has cut, is going to hurt their top line revenue number. And that cost of goods sold. Net
interest income.
Yeah, the net interest income is going to come down because they can charge less. But if you think deposit rates are dropping 50 basis points today, we'd have to have a debate. The deposit rate is going to be sticky. It's not 30 years ago when the banks controlled all of the deposits and they would lower rates on the deposit side and keep loans higher. The reverse happens now. There's so much competition for consumer deposits, money markets.
So you think they were sticky when they were low. Banks didn't want to raise deposit rates. Yep. Now you think they're going to be sticky at a higher level.
Yes, we're going to see the impact of non-banks, brokerage firms, these specialty lenders. I was out looking in the green room at current money market rates. There's some places that are offering over 5% still. So they're not going to be dropping 50 basis points when that loan revenue dries for traditional lenders. Now, this is the opportunity, is to go to a diversified financial, one that has capital markets, trading, asset management. But a traditional community bank lender, I have a little hesitation on.
Quickly on bonds, any thoughts there, fixed income?
Might be a little late. Everyone's been making the call, and we've been riding that lengthening duration. I'm going to pause on that right now. It's more of a flat yield curve. I'd like to see if this is a 50 basis point because of recession. I think we just hold steady, duration neutral right now.
All right, Mark, thank you very much. Mark Avallone, appreciate it.
Good to be here.
Thank you. And we are just